Hi there. This is Bill with Smart Trades, and it's August 8th around 1:05 p.m. Pacific time, and I'm going to kind of speed read through this report. I've got something I need to do this afternoon, but I did want to get this out there before the futures markets open. Anyway, first off, let's look at the long-term monthly on the S&P, and uh, one of the things that comes to mind looking at this is the classic nature of a possible flat scenario. Unlike the Dow, it's just a regular flat, at least to my way of thinking, in that B is only very slightly higher than the top of at the beginning of A, and the bottom of C is just slightly below the bottom of A. Um, my preferred view of this is that this is just A of a larger correction, and the exact form of that correction still remains to be seen, but the fact that we have three legs down and a possible completion here leads to the probability that the next rally should have three legs back up, and indeed should be a B wave. Um, and basically the implication of that is that the rally back up obviously is a B wave. This is interesting because we have A down, B back up. We're currently in a B wave rally of a larger B wave decline. In other words, we're in B of B of B. There is nothing more unpredictable in Elliott wave than a B wave, basically because it can take virtually any form. It can be a flat, it can be a triangle, it can be zigzag, and it can be any of the variations of those patterns. So it's good to know that basically we have an unpredictable pattern based on Elliott wave theory that we're in the midst of now, and not only is it a B wave, but it's a B of a B of a B, and that means it's going to be an unpredictable time for a bit. So that's just the way it is. Let's move on here. And again, let's just go back one quick look. My ideal target has been lowered a bit, assuming that this whole decline is A, that we're finishing up B shortly. We could go down as low as, say, the 900 area on the S&P cash, assuming my count is correct. Now, the Prechter count and the famous counts out there obviously are calling for much lower prices. So if we were to plunge through 900, that would be a very bearish sign, and to my way of thinking, at least would indicate the possibility that we're going to retest the March of '09 lows. Here again is part of the quandary in this count. On the shorter term basis, on the daily charts, was this A here? Or did we finish A at the lower level down around 1010 in the S&P? And it really doesn't matter whether this is a B wave or an X wave. To my way of thinking, you have a corrective decline, you have a corrective rally back up, and really X waves are just a fancy way of calling a B wave a different name, in that basically both B's and X's are corrections within corrections. Okay, this is an interesting footnote. Rarely looked at is the weekly NASDAQ 100 cash. And as you can see, actually off of the late 2008 lows, we made a higher low in 2009, and you can count this as one up, an ABC down to a higher low, and that would be wave 2, a possible impulse wave 3 up, and then a completed ABC down. And then we may be indeed in a fifth wave up on the NASDAQ weekly. This isn't necessarily all that bullish, in that if it made a new high on the longer term chart, you'd actually have an ABC up and a completed, obviously, 5-wave pattern off of the late 2008 lows. That said, it does point to the possibility that we might see new highs in the NASDAQ and maybe the S&P. And on that note, here's the DAX, the German DAX composite, and thanks to stockcharts.com, I borrowed their chart here, and as you can see, we have what looks to be an ABC corrective decline, and I think this best counts as a ABC corrective rally. So A down, B back up, and the possibility that we're forming a flat, and that the DAX is going to come back to about 5,500, 5,600. The point I'd like to make about this chart is that both the decline and the rally are corrective, and this puts a hole in the idea that we're getting ready to start a third wave to the downside, which again is a very popular outlook out there, both by famous and not so famous Elliott wave practitioners. Here's a short-term 240-minute chart of the S&P futures. This is a possible count that we've already got a top in. I don't favor that. Here's another view of that, and we do have Fibonacci resistance right overhead. I'd like to bring your attention to the low volume on this 240-minute continuous 24-hour chart, and the low volume in these flat areas. I think it's a mistake to count based on continuous data because of the low volume overnight. You tend to get a lot of what I would call false corrections. Here's the NASDAQ futures, the NASDAQ 100 futures, and this is a 5,000 tick bar, and you can see the very different form that we have off of the high when you use a tick bar. Each bar is 5,000 ticks, obviously, and we actually show this more as an expanding triangle correction, and again implying that we're going to see new highs for the market. Here's how different it looks looking at the 60-minute chart, and again you can see these areas of flat volume and the distortion in the corrective patterns. And here, this is the S&P futures 24-hour on a 10-minute chart. I'd bring your attention to this sharp decline here. The volume on that, in that 10-minute bar, is 150,000. Okay, going back to this flat period, that's not 25,000. That volume is 25 ticks. So you've got you're comparing, giving equal weight to areas where you have just a tiny fraction of the volume of other areas. And just the nature of the markets is that low volume areas tend to be low volatility areas, and I think it's misguided to use these 24-hour charts as your only source of wave counts, particularly if you're going down to hourly or 15-minute counts. Okay, onward and upward at least a little bit. That's my point of view. The S&P cash 60-minute here, day session only, and I'm looking at this rally here. I believe that this actually counts best as a five waves up off of the low. We have a B wave decline, and from there you can count this rally as a ending diagonal triangle. 1147 will break this count. 5 will be longer than 3 at that point, but ideally we're still in that target zone, 1130 to 1135 or so, perhaps a little higher up to the top of this wedge. And we do have declining breadth. This chart was made a bit before the close on Friday, so it's not quite up to date with the close, but the basic pattern remains. We rally back up here. I think there's a little more to go, but a break of a break of wave 4 is bearish, or a rally through 1147 kills the count and probably points to higher prices. Dollar index. Very quickly, we have what I think best counts as, and you can argue where to put this wave 4, but basically we have 5 waves up and we have a corrective decline. Now the previous 4th wave, regardless of how you count it, at least to my way of thinking, comes in around this area, around the 80-50 area. Let's go on to the next chart for a little more detail. Also, just first, let's look at the possibility that this rally, 5 waves up A, corrective B, and C up. It's not impossible to count this entire rally as a corrective wave, and the implication of that is new lows. But let's assume for now that this is an impulse up. Previous 4th wave again comes in somewhere between 80 and 80-50. We've got 1.62 times the first ABC in this count, comes in around 80-40 or so. 1.62 times A, the blue A here, comes in just below 80, I believe. At any rate, all of these, this cluster, the previous 4th wave, these two Fibonacci targets, both target the area where we are right now. And so I think if if the dollar index is good to go, it's got a hold here, and it should rally sharply over the next few days. This also has implications, obviously, for the stock market. A sharp dollar rally is probably going to be bearish for the stock market. So I think it's worth watching the dollar here over the next several days. And finally, here's crude oil. I think crude has reached a very interesting area. It could rally a bit more. We've got a 62% retracement of this entire decline, comes in just overhead around 83.70. We've got two similar magnitude ABC patterns possibly terminating also in that 83-84 area. You can see here we have a bear flag, and here's a slightly longer term view. So you not only have a bear flag on this second ABC, but you have a bear flag on the larger pattern off of the lows. And this indeed is testing an even larger bear flag coming off of the 2009 lows. So very critical area for crude oil. Again, multiple Elliott wave targets, trend line resistance, Fibonacci 62% retracement. They're all coming in just overhead. So let's watch crude oil here over the next several days. Okay, that's it. I got to get out of here. Have a great week ahead. Thanks for watching.